For decades, since China reopened to the world in 1978, for a long time, this country was getting bigger and richer really quickly. From 1991 to 2011, it grew by 10.5% every year. But then, when Xi Jinping became the leader of China, things slowed down a bit. China's economy is slowing down because of big changes in how money is being used. In the past, there was a lot of borrowing and investing money, which helped the economy grow really fast. But now, that's not happening as much. It's like the country's bank doesn't have as much money to lend out, so things aren't growing as quickly as before. The problem with houses is getting worse. Not many people are buying houses, so even big companies like Country Garden are having trouble. This problem is also affecting other parts of the banking system, where people lend money without much supervision. Some cities are having money problems because they've been spending a lot of money to deal with COVID for 3 years now. Also, they're not selling as much land as before. Because of this, some cities don't have enough money to pay back the money they borrowed. So, they have to cut down on things like garbage pickup or helping older people with medical costs. This is the story that something terrible is happening in China. China's economy had a really tough time last year, and this year might be even harder. But if we look back, China's economy has changed a lot over the past 40 years. It used to mostly focus on farming, but now it's all about services and making things. China is also the #1 country when it comes to trading with other nations. Lately, though, China's amazing growth hasn't been as strong as before. Even before COVID caused shutdowns, things were slowing down. This happened because there are fewer young people, the housing market isn't doing as well, and the government is taking more control over the economy. Also, China isn't getting along well with some of its Western partners, which could make things even harder for its economy to grow. People thought China's economy would bounce back fast in 2023 and keep leading the world in growth. But instead, it didn't pick up as expected. In fact, it slowed down so much that the International Monetary Fund and others are saying it's actually holding back the growth of the whole world. Even though China has lots of issues like problems with houses, not many people spending money, and a lot of young people struggling to find jobs, most experts believe that the country will still manage to reach its goal of growing by about 5% this year. China's amazing economic growth happened because the country made some big changes. They started doing more business with other countries and let people make decisions about money more freely. This began when China became friends with the United States in 1978. Over time, China let people decide more about what to do with their money. They also allowed more businesses from other countries to invest in China and trade with them. This made China's economy even stronger. One big change was letting farmers make more choices about their farms. And in the 1980s, they made special areas by the ocean where they could try out new ideas to help the economy grow even faster. In 1992, during a big meeting called the 14th National Congress, the Chinese Communist Party decided to make some changes to how the country's economy worked. They started thinking more about using markets alongside their socialist beliefs. They made a bunch of new rules and changes to things like who owned businesses, how the law worked, taxes, and how money was controlled by the government. They also started letting people buy and sell things more freely. All of this made the economy a mix of both markets and government planning, instead of just being run by the government. From 1990 to 2007, China's ability to get things done better and faster, called productivity, grew by about 4.5% every year on average. The times when productivity shot up the most happened when small businesses in towns and villages grew a lot in the mid-1980s, when the big government-owned companies changed in the mid-1990s, and when China started trading more with other countries and letting foreign companies invest after joining the World Trade Organization in 2001. Starting in 2010, the Chinese government got more involved in private businesses in 3 main ways. First, they started owning a little bit of many private companies. Even though the number of companies owned completely by the government has gone down, the number of companies where the government owns at least 10% has gone up, from about half to about 60% from 2012 to 2017. Secondly, leaders of the Chinese Communist Party started to have more say in how businesses are run. In 2002, only about 27% of private companies had a party group inside them. But by 2018, China's government made it a rule that every company listed on their stock market must have a Communist Party group. China's top leaders are now saying more clearly that they want the Communist Party to be more involved in private companies. They want party groups to work closely with these companies to make sure they're run well. Also, starting in 2020, Chinese leaders started being stricter with rules for businesses inside China, more than they used to be. From 1979 to 2008, the United States and China were getting along well and were friendly to each other. Sometimes they had disagreements, but they usually talked them out, and it didn't really hurt their friendship in the long run. But now things have changed. The friendship between the US and China is the worst it's been in 40 years. This started becoming clear in 2011, when President Obama talked a lot about focusing more on Asia, and it got even worse when President Trump said a lot of negative things about China and started a trade war in 2018. The US has put rules to stop money going out from American companies to invest in Chinese ones, and to stop money coming into the US from China to prevent China from stealing ideas. In 2020, the total money going between the US and China for direct investments went down to $15.9 billion because of problems caused by the pandemic and because the US and China aren't getting along. These rules, along with the US stopping important technology like computer chips from going to China, have made it harder for Chinese companies to grow. Since Xi Jinping became the top leader in China, the country's economy has been getting weaker. It can't grow as much as it used to when it was led by other leaders for the last 30 years. Because of this, China doesn't have enough money to keep growing like it wants to and become one of the top advanced countries. Many young people in China can't find jobs, and the real estate market, where a lot of families keep their money, is falling apart. Also, Xi Jinping is making the government more controlling, watching people closely. China also has problems like not enough good schools and support for people who need help. With all these issues and the world economy slowing down after COVID, it's hard for the government in Beijing to keep people happy and supportive. China has some big problems that are built into how the country works. There are fewer and fewer people, not enough money for things like healthcare and pensions, lots of pollution, and China needs to buy a lot of fuel, food, and minerals from other countries. Also, Xi Jinping doesn't trust certain parts of the economy and has made it hard for them to do well. This makes it tough for China to become good at making advanced technology on its own. His actions have also made it difficult for China to switch from making things to providing services like internet and other digital services. On top of all this, there's a big problem with the housing market that could make it hard for banks and the government to have enough money. China has problems with things like healthcare and housing, so people don't spend much money, they save it instead. This makes it hard for the economy to grow because people aren't buying enough stuff. Also, China makes a lot of things but doesn't use them all, so they sell them cheap to other countries. This makes those countries upset, and they make rules to stop China from selling so much. Less money from other countries coming into China might not be completely bad for China's economy. When foreign countries invest less money in China, it puts pressure on the Chinese government and local leaders to find ways to keep the economy growing even when it's slowing down. This could push them to come up with new ideas and strategies to strengthen China's economy from within. Chinese companies are spending more money to invest in other countries than foreign companies are investing in China. Actually, foreign companies don't seem interested in investing in China at all anymore. In the last 3 months leading up to September, foreign companies took out $12 billion from China, which hasn't happened in a long time. Foreigners have been selling the Chinese government bonds they owned. In late 2021, China's official data showed that foreigners had about $430 billion worth of these bonds. But by the middle of 2023, that amount had dropped to around $340 billion. First of all, there's not as much reason for businesses to invest directly in China anymore. The extra profit they could make from foreign direct investment, FDI, has gone down a lot. This happened because the US Federal Reserve, which is like the bank for the United States, made some big changes to its policies. The changes raised the risk-free rate, which is like the minimum return businesses can get without taking much risk. This made it less attractive for businesses to invest money outside their own countries. The The government wants to release more money and make it easier to borrow so that they can support new types of investments that Beijing thinks are important. These include things like high-tech industries, farming, and clean energy. China needs to focus on investments in areas like high-tech industries, farming, and clean energy instead of building more empty buildings. This is important to protect itself from unfriendly trade policies and potential sanctions from Western countries in the future. At the same time, the United States is becoming less interested in investing in China as part of its strategic foreign policy. Countries in the Middle East, especially those in the Gulf Cooperation Council, GCC, are willing to increase their investments in China. This is happening as their diplomatic and economic relations with China are getting better. The 6 GCC nations, Saudi Arabia, the United Arab Emirates, Qatar, Bahrain, and Oman, have sovereign wealth funds with a total of around $4 trillion in assets. Only a very small portion, less than 2%, of this money is currently invested in Asia, which includes China. However, experts predict that this is likely to change in the future. One prediction suggests that investment from GCC countries could reach $10 trillion by the end of this decade, with a significant portion, around $1.2 trillion, being directed towards China by 2030. Some foreign direct investment, FDI, might find its way to China through indirect means, especially as players seek to bypass restrictions imposed by the US government on investing directly in China. They might do this by rerouting their investments through financial centers like the UAE before ultimately sending the money to China and other parts of Asia. There's evidence that GCC countries and China are increasing their economic ties. For example, in March 2023, Saudi Arabia announced that its state-owned oil and gas company, Aramco, would collaborate with China to build oil refineries valued at RMB 83.7 billion. Additionally, Saudi Arabia signaled an improvement in its diplomatic relations with China by expressing its intention to join the Shanghai Cooperation Organization, a regional security and trade group led by China. These developments could facilitate discussions between Saudi Arabia and China on trading oil using the Chinese currency, renminbi. The property industry was using too much money. By 2018, investments in real estate made up nearly 20% of China's economy, but only 2% of people were working in it, according to Bloomberg Economics. Most of the 16 million workers in this sector were migrant workers who were paid very little and had to work long hours on construction sites. Meanwhile, the bosses at the top became billionaires.